What's up, guys? I'm Nobody Special, and today the U.S. GDP numbers were released, and for the third quarter of 2021, the U.S. economy grew at a very disappointing 2% year over year, while most analysts were expecting 2.8%. And as you're going to see, there may be some big trouble ahead for the U.S. economy. You ready? Hit it. Thank you for joining me. I'm Jack Gamble, and I'm Nobody Special. And today, the Commerce Department released its third quarter GDP numbers, and the U.S. economy grew at a very disappointing 2% year-over-year gain. Now, analysts were looking for 2.7, 2.8%. Earlier this year, estimates for the third quarter were as high as 7%. So the economic outlook for the U.S. is getting worse and worse by the month. And this follows second quarter GDP growth of 6.7%. So growth is coming down, and it's coming down fast, and we don't know how far it's going to get. Now, real quick, before we get into the numbers, I have to ask you folks first, could you please thumbs up, subscribe to my channel, and don't forget that notification bell. It really helps me out, and it helps me to keep this channel growing. Now, real quick, if you're new here, GDP stands for Gross Domestic Product. That is the sum of all goods and services produced in the United States for the 3 months ended in September. And when you hear GDP growth or GDP contraction, that is the year-over-year change in the sum of all of those goods and services. Now, right now, the United States is in a period of economic expansion, where the sum of all goods and services is increasing year over year as we go. Now, when that number goes negative, when the sum of goods and services starts to decline, that's when you're in a recession. And the technical definition of a recession is 2 consecutive quarters of negative GDP growth. And although the economy is still growing right now, it looks like a recession is all but inevitable. And we're going to get into why in a little bit. Now, with that, let's shrink my big fat melon of a head. And this is off of Fox Business. U.S. economic growth falls short of expectations as consumer spending slows. U.S. economy grew 2% in the third quarter. U.S. economic growth decelerated in the third quarter as consumer spending slowed amid a resurgence in new COVID-19 cases and as government assistance payments decreased. Now, that is the big one there, government assistance payments decreasing. The U.S. economy is coming down from a massive sugar high or a hangover or whatever analogy you may want to use. All of this stimulus and all of the printed money and everything that was pumped into the economy was a temporary feel-good, but as we're going to see in the coming months, it leaves you feeling like crap later on. Reading on, gross domestic product, the broadest measure of economic performance, grew at a 2% annual rate during the 3 months through September, the weakest of the recovery, according to an advanced estimate released Thursday by the Commerce Department. Analysts surveyed were expecting a 2.7% growth. Second quarter GDP was 6.7% growth. The Delta wave of infections, the waning fiscal stimulus, and shortages, particularly of motor vehicles, triggered a market slowdown in consumption growth, said Paul Ashworth, chief U.S. economist at capital research firm Capital Economics. So there's no big surprises in there, right? COVID is still going on. The shortages are obviously happening, particularly in motor vehicles. And the stimmy checks have stopped flowing, with the exception, of course, of the expanded child tax credit. And all of these things are having an effect. People are spending less and less money. It's harder to get stuff. People have less money to spend on it. So the economy is growing at a much slower pace. Now, here's the thing. The economy should be growing at breakneck speed right now. Now, you might be asking why I say that, and you have to look at Federal Reserve policies. You have to keep in mind, interest rates are still set at near zero. That means it's easier than ever to borrow money, and it's cheaper than ever to borrow money. So companies that want to invest in expanding their business have more access to capital now than they typically would have. And on top of that, the Federal Reserve is still pumping $120 billion a month at least into the economy. Now, they have been talking about tapering, and they're saying they're going to taper very soon, but the Fed is still pumping money into the economy. So we've still got near zero interest rates, and we're still quantitative easing and printing money, and the economy is only growing at 2%. So in other words, we're sitting in the car, and we have got pedal to the metal. The engine is roaring and racing, but we're barely moving. Does that sound like a healthy engine to you? Now, with the taper and the pending interest rate increases that they're talking about by the end of next year, that's going to be the Federal Reserve taking their foot off of the accelerator. So what do you think is going to happen to the forward momentum of that car when we stop giving it gas? It's going to slow down, or it's going to start rolling backwards down the hill. And considering this information, considering the rapid rate at which GDP growth is slowing from 6.7% all the way down to 2% in one quarter, considering the fact that we're about to taper the quantitative easing at the Federal Reserve, considering the fact that interest rates are headed up next year, and we're already starting to see an increase in interest rates as the bond market front runs those rate hikes, then it's becoming apparently clear that the U.S. is in for a recession. And remember, a recession is defined as 2 consecutive quarters of negative economic growth. Now, again, I just want to emphasize we are not in a recession right now. We are still in a period of economic expansion, barely. And considering how accommodative and how dovish Fed policy is, the economy should be growing at a much faster pace. And with the hawkish changes to Fed policy that are on the horizon in the coming year, it should be obvious to anyone who isn't on TV desperately trying to spin these numbers to make themselves look better that there is a recession on the horizon in the United States. There's one coming. Bank on it. Now, real quick, I just want to point something out. Stocks do not seem to care. All right, here's the S&P 500, 2% economic growth, the inevitability of a recession. And look, onward to new highs. There's no time. Stocks must go higher no matter what, no matter how bad the economic data gets, no matter how dire the situation, no matter how obvious the imminent collapse of the Chinese economy is. Onward to new highs. And let's check, maybe the NASDAQ is a little different. Oh my goodness, look at the NASDAQ. Nope, onward and upward, new highs. Never mind that the U.S. economy is slowing. Never mind that China is on the brink of collapse. Never mind that the global supply chain is grinding to a halt, that every cog in the machine is making noise and wobbling and grinding and vibrating, and something is clearly wrong with the global economic engine. Onward to new highs. Folks, this is the blow-off top forming, all right? We are in the final innings of this stock market rally, and this is why I keep saying I'm in cash-raising mode. After a report like this, after such disappointing GDP numbers, the fact that stocks continue to go up in light of the inevitability of the Fed's tightening. And remember, as the Fed tightens, folks, it gets harder to do business. So all of these companies are looking at a decline in earnings in the horizon. The fact that they're making new highs day after day is a joke. And this is why I'm raising cash right now. Now, again, I'm not a financial advisor. Do your own research, do your own DD, arrive at a decision that's right for you based on your unique situation. This is just financial edutainment. But folks, look at this chart. This is ridiculous, okay? There is a reckoning coming for the stock market. I don't know when. It could go on for another 6 months. It could go on for another year. Who knows the new highs that we could make? All I can tell you is it is going to be swift and it's going to be brutal when it hits. Oh, and by the way, Evergrande has 1 day to make their payment on their latest bond coupon before they go into official default. Tomorrow night, that's it. So are they going to make a last-minute payment like they did last week and buy themselves some more time? Who knows? But the actual default of Evergrande, which they have not defaulted yet, but they're 1 day away from an actual default. If they don't make that 11th hour payment, who knows the reaction Wall Street might have. So for all we know, we could be 24 hours away from a major sell-off. Or the news won't hit until after close of business tomorrow, and then there's going to be carnage over the weekend, and then Monday we have a major sell-off. Or it could be 6 more months or a year. We could go up another 10,000 points from here. Valuations don't matter in this ridiculous day and age. Onward and upward to new highs. Throw money at Cathie Wood. Let her do what she wants with it. She's going to make you money. Dump a few thousand into Shiba Inu. Who cares? Onward and upward, right? The era of funny money is coming to an end, okay? I don't know when, but it's soon. It's catching up with us. This hangover, this sugar high, it's over, all right? The rush, the feel-good is over, and now the pain sets in, and it's coming. I don't want to be too fuddy here, folks, but this GDP number, 2% growth with the accommodative Fed and with all the money that's been pumped into the system, that is disappointing, doesn't even begin to cover it. We should be growing at 5 or 6% looking at these kinds of numbers. And that tells me as soon as the Fed lays off the gas, the consecutive quarters of negative economic growth are going to start piling up. There is a recession coming in 2022. Now, the earliest a recession could start would be in March of 2022, because remember, it takes 2 consecutive quarters of negative economic growth. With the current trajectory going from 6.7% to 2% in 1 quarter, suggests we could have negative economic growth as early as the 4th quarter of this year, in which case a consecutive 1st quarter 2022 negative GDP number would mean an official recession. And that would be the 2nd recession in 2 years. Because we had another short recession in 2020 with the onset of the pandemic, and then that was over as soon as it started because of the trillions they pumped into the economy. Anyways, folks, again, this is not financial advice. This is not investment advice. This is just to arm you with information. This is just financial edutainment. Anyways, folks, that's all I got for you on this one. I want to thank you for your time for watching this video. Don't forget, give me a thumbs up, subscribe to my channel, hit that notification bell. It really helps me out. Also, tomorrow's Friday, so as a reminder, at 3:15 p.m. Eastern Time, I'll be doing my weekly Power Hour live stream, so don't forget to join me for that one. Till next time, live small, dream big.